Good afternoon, everyone. I hope you're all having a fantastic Carnegie conference. I'm Jess Howland. I'm the operations manager for the web team, and I am here today with Ryan Popper, who is going to be presenting on Foundations of Finance, Understanding the Pillars of Business. Just a little bit about Ryan. He is the adventurous and scrappy contender. His colors are maroon, blue, and green. And Ryan has had a number of different positions over the course of his career. He started off in management consulting before transitioning to a more finance-focused roles. He was previously with Carnegie's former partner, New Heritage. He lives in Melrose, Massachusetts, with his wife, his son Aiden, who's almost 6 months old, and their firstborn, who's Cooper, a golden retriever. Ryan joined Carnegie last year as CFO, and he's thrilled to be here. He loves having the chance to work with all of these bright minds at Carnegie, loves being part of the operations of the business, and he's excited to nerd out with all of you on the world of finance today. So take it away, Ryan.
Thank you for the introduction, Jess. Happy Thursday, everyone. We'll jump into this presentation. I've got a few slides to talk through, and then we're going to do my favorite thing and where I spend 70 to 90% of my time, which is nerd out in Excel. So that is the agenda that I do. I'm going to share my screen here. I'm going to go full screen. Actually, I don't need to. Can you all see that? Is that okay? Does that work? Then I can see your beautiful faces. Otherwise, I can't see your faces. All right. So we're gonna talk through some goals that we're gonna accomplish today, and then I'd also like to just say, please add comments in the chat. Happy to jump in at any point in time if you all have questions on something. Let's handle it real time. I don't have that many slides, so all good. Let's make this conversational. All right. So I think, like anything that anybody does professionally, there's going to be different definitions that folks have. I'd like to share with you my definition of finance and hopefully kind of frame it in approachable terms. Hopefully we can spend a little bit of time kind of exploring finance's role in our society, not to get too philosophical, but I think it's a fair way to frame the conversation. And then lastly, we'll dive into kind of what I call FP&A, the financial planning and analysis function here at Carnegie does. My team's role day in and day out. So without further ado, let's jump into it. So I'm gonna start with a question. What is finance? If anybody wants to drop into the chat, I think of it as sort of framing up the strategic allocation and sustainable management of two things that I believe are the most limited resource in our world. Any guesses? You can go off mute and shout it out too if you want. Curious to hear what people think.
People knew it right away.
Yeah, love it. All right. Time and money, right? Two things that it's hard to make more time, and we all wish we had more money. So it's, at the end of the day, I think finance is really about, like I said, the allocation and management of those two things. And it really boils down to balance, which again, not to get too philosophical, but I think it's an interesting way to approach what we do in finance is really, it's that balance. It's risk reward trade-offs, and it's about ability to grow versus sustainability of a business. So without further ado, let's jump into where we see finance in society. So I thought it might be helpful, I think when I was in college trying to understand, like, okay, cool, I like numbers, I like math, I like business, I know I wanted to go into finance, but like, what do I want to do in finance? And there's many different kind of areas that you can play within. I thought I'd try to frame it up, and if folks have other thoughts or perspectives, feel free to jump in here. But to me, it sort of spans from kind of the macro lens to the micro lens. So on a macro perspective, you've got our U.S. government, our central bank, that are trying to set monetary and fiscal policy about federal fund rates, open market operations, which I clearly didn't finish that sentence on. We're going to pretend that wasn't there. But that's all about, right? Like how much debt does the U.S. government issue? What's the federal funds rate set at? How do we try to balance, frankly, growth and inflation, right? Which we've been hearing about in the news quite a bit over the past few years. And again, it's that trade-off. If we lower interest rates, you're going to get more growth, but you're also going to have higher inflation. So that's why we try to strike a balance in terms of where that inflation metric sits at and what our GDP is growing at, right? So anyways, big picture, government, central bank, starting to get a little bit closer in. I put here sort of retail and commercial banking, right? So like banks, credit unions, lenders, when you need a loan on your house, if you're buying a new house, new car, where you get your paycheck every 2 weeks deposited, right? Those institutions are really trying to, again, going back to the balance, how do they grow their book of business, for example, loans, but also not get out over their skis and have a super high default rate by loaning money to super risky folks that aren't going to be able to pay them back, right? So again, striking that balance there. And then there's this whole world of investing, right? There's sort of like folks that are wealth managers. There's folks that are in the public markets. Typically, when you hear hedge funds, that's going to be folks that are in the public markets. They're, raising capital, investing it in public companies like Apple and Tesla. There's private market investing, like the whole world of private equity and venture capital. They're raising funds and then investing those dollars into exactly what it sounds like, folks that are not public companies, right? Small private companies that are growing and they're trying to make a return on investment in their dollars. Those folks are, what they're really focused on is balancing, again, risk and reward, right? So higher risk, you should get higher reward. Venture capital, just to say it, like they're investing in small checks into lots of companies, knowing that many of them are frankly going to go belly up and go bankrupt. But they're going to have one in every 20 deals they invest in is they're going to get a 100x return on their money, and that makes up for all the losses, right? Things like portfolio allocation and wealth management, right? That's what you hear all the, sure, folks have talked to their representatives at Vanguard or Fidelity or something like that, right? Where they're trying to say, hey, as you get closer to retirement, you need to consider, mix shift in your portfolio more towards fixed income, right? Where you might not be getting as much growth in your overall portfolio. That's more sort of like investing in bonds, public bonds, versus public stocks, public equities, which tend to have more volatility, more growth. Again, that risk reward trade-off. And then moving into sort of FP&A function, financial planning and analysis. So this is, again, here at Carnegie, this is what, my team and I do day in and day out and try to serve this function for the company. I put sort of the CFO, controller, there's a bunch, staff accounts, other things like that, where we're really trying to I always say that keep the train on the tracks, right? Understand what we did last month, understand how our current performance is trending versus, frankly, the budget that we set at the beginning of the year, our latest forecast, where we're trying to get to. We'll spend a little bit more time on the following page diving into this. But really at its core, the FP&A function, again, going back to balance, is about how do we think laying the groundwork today that we need to grow in the future. So in order to grow, for example, revenue, we've got to add sales folks, right? But if we add 100 sales folks, we won't have any money today. So how do you optimize for that balance of growth, but also sustainability of the business? And then on the super micro level, I would put sort of personal finance, right? Like we're all managing our paycheck every week, and we'd all like to ideally, go on crazy vacations and buy the biggest TV we can buy and the nicest car we can buy. But you got to, again, balance. What do you want today? What do you want to enjoy today versus what do you want to save for the future, right? So anyways, hopefully that's helpful. Any questions on that? I thought I would just frame it big picture. Great. Awesome. So let's talk a little bit about what FP&A looks like at a company level. And a lot of this stuff is frankly, where we, me and my team spend all of our time. So in no particular order, we'll try to talk through some of this. So at the beginning of the year, we work with all the division leads to really set the budget for the year. So we say, hey, our revenue goals are this. In order to hit that revenue goal, we need to have the sales goals of this. In order to support that revenue growth, these are the heads that we need to add. Hey, we need to do X many offsites. So it's a very granular budgeting planning process that we go through, and trying to frame out the entire year by month to understand everything from revenue, costs, all the way down to profit at the end of the day. We'll get into that when we get to the Excel portion of the presentation here. But at a high level, that's what we do every year, and then frankly every month we're going through and saying, hey, how did we do versus budget versus prior year versus latest forecast, and that this last one on the left hand side of the page here, forecasting. This is sort of like a constant process that we're going through, right? So anytime a team needs a new head, or if someone is leaving the company, right? How do we slot that in? How do we make sure we have visibility in our forecast? It's a lot of Excel files that all kind of keep all that stuff in one place. really the ultimate goal, right? To have transparency and visibility to understand where we're going and what our expected results are. Pricing is a big one. So like, again, in terms of optimizing prices for our solutions, we'd love to be able to charge every customer, more money, but at some point they'll go somewhere else, right? So how do you balance raising prices with also, not losing customers and assessing elasticity of demand? If, not to get all economic on us, but like if you have inelastic demand, that means you can charge no matter what you charge for the product, your customers are still going to come back, right? So there is an elasticity curve that at some point, if you charge them too much, they're going to go elsewhere. So that's something you got to keep an eye on. And we get involved in real-time negotiations on new opportunities, right? If a customer says, hey, we really want to work with you, but we can only come to you if your price is X, right? So how do we think about that? Where do we draw the line? What are we willing to do in terms of going down to percent margin on some of our offerings? RevOps is one that's I've gotten pretty involved with over the past year. This is really about tracking our sales progress over the course of the year. So how are we doing versus goals, right? Q2 and Q3 tend to be our biggest sales seasons. How are we doing versus prior year by type of client, whether it's a new client, whether it's renewals, just again, trying to track that, measure it, put it all in one place so we have one source of truth when we're trying to understand how we're performing. A lot of ad hoc analysis goes on. Worked with divisional leaders to create bandwidth trackers. So, getting data from Tin Man and then slicing and dicing that and trying to understand, okay, each of my strategists can handle X number of clients, right? All that kind of good stuff. And then one thing that we've been doing recently is trying to understand with all of, and thank you all for those that are tracking their time in harvest. One of the big things that'll be very helpful from a FP&A perspective to come out of that will be to understand not only client load, but also, hey, do we have specific clients that are actually, either more profitable or less profitable once we actually burden them with the amount of labor that goes into serving that client, which helps us make decisions on pricing and the like. Treasury management is a fancy word for basically like cash flow management, right? So Zach and I spend a lot of time, shout out to Zach, our controller here at Carnegie, a lot of time looking at sort of the cash flow needs of the business, right? When is AR going to get collected? When does AP get paid? We've got lenders that we can pull from when we need to, make a big payment and might not have that cash on hand. We call it like a revolver, right? Revolving line of credit that we can pull from in order to make some of those. So anyways, a lot of thought process goes into that. And then data aggregation and synthesis. I don't know if anybody was just on James's presentation there a few minutes ago, but he talked a lot about this, and it's all about aggregating the information, frankly, from disparate systems, right? So just to put together our forecast, just to say it, we're getting backlog information from Tin Man, we're getting pipeline information from Pipedrive, we're getting census information from Insperity, we're getting historical financial results from Sage, and it's about aggregating all of that into one place to put together the full picture of where have we been and where are we going. The last one that I'll touch on here, I would just call it kind of pure play accounting. It's really about maintaining and analyzing accrual basis 3-statement financial models. So what is a 3-statement financial model? Well, I would argue they're sort of the lifeblood of the business and sort of the best way to assess, frankly, just like the financial viability and financial condition of a business, right? So if you were to ask me as a finance nerd, what could you see about a company that would tell you kind of how it's performing? I would say the 3 statements. Like if I can get my hands on the 3 statements, I can tell you a heck of a lot about the business, and we'll go through sort of an illustrative example of that in a moment here. But the 3 statements are profit and loss, balance sheet, and statement of cash flows. The profit and loss statement, that's what I referred to earlier. That's where you're kind of going from revenue all the way down to earnings and all the costs in between. Allows you to understand, how are we doing from a trajectory perspective? Is the company growing top line and bottom line from a revenue and earnings perspective? Allows you to understand how profitable the company is. So for every dollar of revenue, how many cents of that fall down to the bottom line in terms of profit? That's what we call the profit margin percent. And then things like what's the mix of fixed versus variable costs, right? So if we get in a pinch, revenue declines in a certain area. Hey, do we have subcontractors doing the work, which it's easy to kind of turn off and on, versus if you have fixed headcount, very very not easy, right? You can't just turn that off and on, right? So assessing things like that. Balance sheet is very helpful to understand the cash position of the business. Obviously, the balance sheet is going to report. Think of balance sheet as like your bank statement at the end of the month, right? So Your profit and loss statement is going to show you what came in, what came out. And then your balance sheet is really kind of like what's left at the end of the period, right? So every month we look at that, and it's, got cash on the accounts, or sorry, on the asset side, liabilities and equity on the other side. Again, we'll talk through that in a second. But allows us to understand things like how much cash does the business have? Is the business over levered, which is basically a fancy way for saying, does it have too much debt, and can it not support that amount of debt? And then also understanding things like how quickly the company can collect revenue from its customers, which is DSOs, days sales outstanding, which we'll get into in a little bit. And then also pay vendors, which would be DPOs, days payable outstanding. The statement of cash flows is basically you take your profit and loss plus your balance sheet, you put those together, and then you get your statement of cash flows. That allows you to see you started with cash balance of X, you had profit and loss that moved cash, and then you know what your ending cash position is from your latest balance sheet date. And your statement of cash flows, sort of think of it as the bridge between those two items. So any questions on that? Otherwise, I'm going to jump into the Excel portion of our presentation here, and I'll try to give you guys a quick rundown on what this all looks like. All right, awesome. Welcome to Excel. So everyone see the Excel screen? Thumbs up, yes? Okay, great. So these are the three statements. So I've simplified this a tremendous amount, but when people talk about the three financial statements, this is what they're talking about: profit and loss, balance sheet, statement of cash flows. I've done an illustrative sort of like 3-year build here of a business. So let's just talk through this. So the business in the first year makes no money. Let's say you got to spend $50 on marketing, right? So you spend $50 the first year, you don't have any customers. Year 2, awesome, we've got some revenue now, but we had to, I don't know, let's say this is I'm going to be super lame. We'll say this is a lemonade stand, just to throw out the example, right? So the second year, we generate $200 selling lemonade, but we had to buy, so cost of sales, that would be, the lemonades, or sorry, lemonades, the lemons, the sugar, the cups, right? Cost of sales. But then we also spent some more money on marketing, and we had to pay Sally Lou down the street to staff the operations for us. And so we made $50. And then year 3, we actually make even more money. So now you can see, this is what I was getting at before, right? Your revenue year over year, great. You had 50% revenue growth. That's wonderful. Congratulations. Your cost of sales went up, from 90 to 130. So your profit margin, right? Your gross margin is what we call it for like the items that are in cost of sales, which is sort of like your direct costs, right? Those would, this would say you actually, you saw an increase in your gross margin percent, which is wonderful. You want to see that. And then ultimately you only had to pay $75 for operating expenses. So your overall earnings margin went from 25 to 32. So does that make sense at a high level? Any questions on the P&L? Otherwise, I'll move to the balance sheet portion of this. Great. So the balance sheet, and this is where it gets interesting, because your sort of balance sheet is a direct result of both your profit and loss and, frankly, the other items that might not flow through your P&L. So see if I can explain this well. So down in your statement of cash flows, you've got this you've got change in cash from a few different areas. You can talk about it, change in cash flow from operations and change in cash flow from financing. We're going to say, in order to support that loss that we had the first year, we had to raise $100 from our parents, right? So we went in and we took on capital. That money went to the balance sheet. You can see we took on $100, we lost 50. So we actually ended the year with $50, right? That makes sense because we raised 100. But that $100 of what I'm calling equity investment, it does not impact your P&L, right? So it's not a direct revenue or expense in the year. It's simply funding for the business, which would just show up in your statement of cash flows and not in your P&L. In year 2, you made $50 of profit. You can see that show up here in our earnings. But let's look at this. So now our AR actually went up. So we're actually assuming that, our lovely neighbors that come and buy lemonade from us, they unfortunately don't pay us immediately. They actually take 30 days. That's what this days sales outstanding metric shows us. So if they take 30 days to pay us at the end of the year, based on some fancy calculations that I won't bore you with, but basically you're trying to say, okay, if it takes 30 days and you made $200 of revenue in the year, how much would be in AR at the end of the year? Well, AR is now 16. So you've only collected $184 of revenue in the year, right? Of real cash from revenue. And the other 16 you're going to collect in 30 days. But at the end of year 2, you would have $16 of AR on your books. Because you actually didn't collect that, but you're due to accrual-based accounting, you're actually saying that you get the full 50 of profit, right, from your revenue that you earned that year. You actually have to subtract that from your cash flow. So anyways, it sort of sits as an asset on your balance sheet. You haven't collected it yet. You're going to collect it next year. Great. But it actually comes as a reduction to your cash flow. The opposite for AP, the grocery store actually let us not pay them for 45 days when we bought the lemons. So we're actually going to have an increase in AP year over year. And so if you increase your liabilities, i.e. don't pay something off, that actually increases your cash flow in the year. So ultimately we had a change in cash flow from operations of 45, no change in cash flow from financing. And so ultimately our change in cash flow from the year is 45. You have your 50 that you started with plus your 45, you end at 95. So on and so forth. So the great news in year 3, you actually were able to take a distribution of 50K because you built up a bunch of money. So congratulations. You were able to maybe pay your parents back for the $100 that they loaned you. And you can see, it's the same idea. You have your earnings, less your increase in AR, plus your increase in AP, gives you change in cash flow from operations, and then minus any distributions that you took, you ultimately are going to have a $42 change in cash. So your cash balance is now up to 136. So anyways, we will send this around. Hopefully that's helpful just to give you all a sense for kind of like when people say the 3 statements of, financial modeling, this is what they're referring to. Tried to make it relatively simplistic, but there's a lot of nuances in this. But at a high level, that's what I have to share with you all today on finance.
Ryan,
Questions?
there was a question. Denise asked, do you ideally want your AP to be 0?
That's a great question. The way I would answer that is similar to if someone were to say, do I want my home mortgage to be 0? And I would say, no, right? If you can, so AP is a liability, right? You can see it sitting on, and sorry, I should have said this, like your balance sheet, for anyone that doesn't know, you always want your assets to equal your liabilities plus your equity, just sort of how things shake out. You actually, you kind of want liabilities, right? And let me talk through that a little bit, right? It's sort of like on your house, if someone said to you, hey, you can buy your house in cash, or I can give you a loan for it. If you could only buy your house in cash, you might only be buying a $50,000 house. But if someone will give you a loan for it, you could buy a $100,000 house, right? And so it's actually favorable to have longer DPOs, i.e. days payable outstanding, because it actually means that you've negotiated favorable terms with our vendors. So the longer our DPOs are, just to say it for Carnegie's sake, right? Like we write a big check to Google and Facebook at the end of the month when we have to pay for all the digital ads that we place for our business. If Google and Facebook said to me, hey, you don't have to pay for 90 days, 120 days, 180 days, I'd say outstanding. I will sign up for that all day long. Thank you so much. Because they just gave me more time to use that cash for other things, right? To grow our business, to pay more payroll, as opposed to needing to pay them immediately. If they say, hey, you actually have to prepay, that would be really bad news because now I have to pay my vendors before I've even collected money from my customers. So what I would say is you never want your AP to be 0. And frankly, liabilities to a degree are healthy, just like having a mortgage on your home is healthy because it allows you more purchasing power. What you want to keep an eye on is to make sure that you don't get upside down, right? Just like, owning a home, you don't want to take on a mortgage that you can't pay. We also don't want to take on loans and other, vendor terms and vendor payables, which is effectively debt that we can't service, right? So that's where we look at things like our net leverage ratio, which not to get too nerdy, but it's basically like the amount of debt divided by our EBITDA, right? Which is like a profit term. And it's just very similar to how a loan would underwrite, or sorry, how a bank would underwrite you if you try to get a loan for a house. Like what's your earnings versus what you have to pay down every month for your mortgage. Pretty fascinating stuff, huh? Everybody loves it.
Did you see the chat though, Ryan? You've got people appreciating that you are in the job that you're in and they are not. And Voltaire is really engaged.
It's kind of like that part in French class when you get to the like irregular verbs and everything just goes over your head, but it sounds so good.
Yeah, hopefully I didn't use terms that were crazy. Rocco would probably be disappointed in me, but
But you used them all correctly, so that was great.
no improper use of bifurcate. It's great. Well, if anybody ever has random questions about financial statements, you know where to find your FP&A team here at Carnegie. But appreciate everyone joining, and thanks for the time today.
Awesome. Thank you
Thanks,
so much,
Ryan.
everybody. Have a
Awesome.
great
Thanks all.
rest of your conference.